Hello, everyone. Today we're going to peel back how crypto trading really works under the hood. Look at Bitcoin on screen. The spot market quotes one price, while the perpetual futures contract often quotes another. Same Bitcoin, so why the gap? And yes, there are strategies that try to earn from that gap. Do they actually work? On top of that, futures traders pay or receive a fee called the funding rate about every 8 hours. In this lesson, we'll cover what that price gap really is, how people try to profit from it, and the risks that stay hidden until they hit. Let's draw a clean line. Spot means you buy now and hold the real asset in a wallet, like walking into a bank and buying euros with dollars, or buying a gold coin you can put in a safe. A perpetual futures contract is just that, a contract. You don't own Bitcoin, you're betting on its price. There is no expiry date, so you can keep the position open indefinitely. Here's the odd part. The same Bitcoin can have different prices in spot and futures. Check the chart on screen. You'll often see that gap live. That gap is called the basis. Futures are usually richer than spot because the market is pricing in an expectation that prices will rise. The same kind of risk-on mood you see when the S&P 500 and NASDAQ are climbing. But futures can't stay permanently expensive versus spot. There's an automatic balancing mechanism, the funding rate. Think of the funding rate as interest paid between traders every 8 hours so the basis doesn't blow out, a bit like rent on an apartment that comes due on a schedule. When a futures price sits above spot, longs, buyers, pay shorts, sellers. Example. If futures are about 500 above spot on this chart, longs might pay roughly 0.02 into the 0.1% of their notional to shorts over that 8-hour window on a DILA 10,000 position. That's a few dollars to maybe $10 each cycle. A positive funding rate means far more people want to be long than short. A signal the crowd may be too optimistic. The same way equity traders get euphoric when the Fed is easing and stocks keep ripping. Negative funding means shorts dominate. Historically, that setup has often preceded short covering bounces. Pros read the rate the way they read positioning in the S&P 500 futures pit. Now, the playbook people use to try to get paid. It's called basis trading. Textbooks often call it one of the safer-looking crypto strategies. The recipe is simple. 1. Buy spot Bitcoin, and 2. Short the perpetual futures at the same time. Say you buy one Bitcoin spot at 115,000 and sell one futures contract at 115,500. That 500 spread is locked in as the starting edge, like locking a 500 coupon before coffee prices move. On top of that, when funding is positive, the short side collects funding every 8 hours, extra cash flow on autopilot. In theory, you don't care whether Bitcoin goes to the moon or crashes. You only care about the spread and funding. It looks like risk-free yield. Reality is not that clean. This is the part that matters. On the perpetual chart on screen, most venues let you use leverage, borrowing 2 times, 10 times, even 100 times your own capital. Think of it like maxing a credit card and watching the balance balloon with interest. The problem, a small move against you eats your margin fast. At 100 times leverage, a 1% adverse move can wipe the entire account, a move that wouldn't even make the evening news on the S&P 500. Warning, when your collateral falls below the exchange's maintenance level, liquidation triggers. The exchange forcibly closes your position and locks in a loss. Worse is socialized loss, when one trader's blow-up gets shared across other winners on the venue. One bad account can splash damage onto people who never touched that trade. So if your clever strategy gets liquidated in a volatility spike, you can hurt not only yourself but other market participants sitting on the same exchange. To read funding properly, you also need the balance of buyers versus sellers. Look at the Ethereum Perpetual on screen and ask who's crowding the trade. When longs overwhelm shorts, funding turns positive and rises. A classic market is too optimistic reading. Historically, extreme positive funding has often been followed by short-term pullbacks. Not always, but sky-high funding is a reliable overheating tell, the same way stretched Nasdaq positioning warns equity traders. When funding flips negative, shorts dominate, and that often acts as a coiled spring signal for a bounce. Funding and basis are thermometers for crowd psychology. Pros use them to judge whether the market is overheating or oversold, just like reading the Fed's tone against risk assets. Bottom line, spot is slower and calmer. No liquidation clock, and the asset actually sits in your wallet. Futures can move P&L faster and even pay funding income, but leverage is a blade. One wrong move can erase everything. Basis trading sounds like risk-free yield on paper. In practice, you still need timing, volatility control, and real risk hedges. The most important warning, leverage, liquidation, and socialized loss can damage you in the wider market. This is extreme risk territory. Warning: this lesson is for education only, not a recommendation to invest or trade. Every trade is your responsibility. Before you put real dollars at risk, be honest about how much loss you can stomach and talk to a qualified professional if you need advice.